Greetings to all of you. Thanks for joining. I know it is Sunday evening. It's always difficult, but thanks for joining, taking our time, I think, to learn more about the climate risk. Let me briefly tell you what is the CRFC, Climate Risk and Finance Council. We are a non-profit professional association. We have incorporated our office in the US. The main objective of this CRFC is to sensitize all the key stakeholders on this climate-related financial risk management, mainly for the bankers, the financial institution perspective, because they are the most regulated. So they have more challenges in understanding the guidelines and implementing. So that is the main objective of CRS. We are into this since last 1 year. We have been doing this research and disseminating the information on on the climate-related financial risk through webinars, through podcasts, and even white papers we have been published. Today's speaker, Mr. S. Gurusamy, he is a seasoned risk professional and specialized in the climate risk. He is actually heading the climate risk division in TCS, the research we are doing. He is an FRM from GARP and also he is certified SCR. SCR certification, the recent certification they have introduced on climate risk, the global association. With his rich experience on consulting and understanding of the climate risk, so today he is going to actually share his thoughts on the data challenges in managing the climate risk and how the industry actually prepare and address the challenges. So that is the main topic. So without losing any time, I want to just hand over the session to Gurusamy. Over to you, Mr. Gurusamy.
Sure. Thanks, Srini, for the context and also the introduction. Thank you. I think we'll get started with the session. So can we have the Q&A at the last part of the session, Srini? What is your preference?
Yes. That's how I think. Okay. We will be asking those people who want to actually have any questions. Please put your questions in the chat window. I will be actually consolidating and we can actually do that Q&A at the end. Okay. Thanks. Go ahead, Gurusamy.
Sure, thank you. So I think with the background that is provided by Srini, so today's agenda would largely cover these key 5 areas. What is the overarching regulatory views around the climate risk data management? And we wanted to break through and clearly understand the data complexity that is inherent with respect to the climate risk management, and what is the ecosystem is how the ecosystem is evolving, and finally, what is the industry direction, how banks and financial institutions are currently addressing this main climate data problems. And I've also, tried hard to extract some of the 4 industry case studies to talk about various data challenges and how each of the bank is addressing through them. So the first section is basically to cover how the importance of the climate risk data and the inherent challenges are shaping up. So recently, the European Central Bank has basically conducted the system-wide climate-focused stress testing, and there were close to 41 different European banks have basically participated in this exercise. So one of the core findings from the European Central Bank as part of this test is that close to 60% of the banks, they do not yet have the climate-focused stress testing framework. And most of the banks, they are yet to include the climate risk into their credit risk models and their credit risk landscape. So embedding the climate risk aspects into their overall credit risk value chain is should to happen. And only close to 20% of the banks, they are currently, considering the climate risk as part of their credit origination or their credit value chain. And also most banks majorly, they come from high carbon intensity sectors. The majority of their income lies from the high carbon intensity sectors, and their banks' financed emissions calculations often include the proxy estimation of their carbon exposures. So this stress test finding shows that there is a lot of improvement that is required, and also from the banks and financial institutions perspectives, there is a lot of capability upliftment required in terms of closing out the current data gaps. And if you look at the key findings, these key findings from ECB report, it stresses that all these 3 points, these 3 summary points revolves around addressing the current data gaps, and it clearly signals that they have to, definitely improve the climate risk data ecosystems for them to move on further, explore a lot of quantifications, developing various risk models, and come up with the effective scenario analysis around the climate risk. So the backbone is building out the necessary data ecosystems and ensure that all the data that they gather is relevant to their organizations to effectively manage both physical and transition risk. So moving on, so here basically this specific slides considering the critical play for critical risk management, climate risk management. NGFS, the Network for Greening the Financial System, has recently created a focused work stream. That work group is actually focusing on doing a lot of research around understanding the climate risk data ecosystems, what kind of data ecosystem is relevant for banks and financial institutions. So they basically wanted to develop a climate focused data directory. That is something like an exercise that has been recently started. The aim of this exercise is basically to bridge the climate data gaps. So the directory will be with an objective to bridge the various data gaps that are currently evident in the banking and financial institutions. As part of this initial study, they also understood the nature of climate data requirement across the banking and financial industry. So for this purpose, they basically created a framework which emphasizes upon in order to understand the core data requirement for physical as well as transition risk, there are 7 stakeholder categories have been considered. So if you look at the left part of it, when it comes to the user personas or the stakeholders, there are 7 categories have been considered. Each of them will be interested upon a specific use case, be it the scenario analysis, be it the climate specific disclosures, and how do they embed the climate risk into their lending and investment value chain, and ultimately quantifying the climate exposures. So these are the 8 different use cases that have been targeted. And once they bring up on the analysis around 7 different stakeholders and 8 different use cases, the next stage was basically come up with the various climate specific metrics that are important to each of the stakeholders and use case, and then arrive at what is the type of data that's required. For example, each of these metrics have been aligned to either the carbon footprint or what is their vulnerability to the various physical risk categories, how is their portfolio is aligned to their overall net zero goal, and how is the transition sensitivity is aligned. So each of these metrics basically have been broken down, and they are able to find out close to 1,200 data points. So this is the complexity of the multi-stakeholder and multi-dimensional data requirements underlying the backbone of the climate risk ecosystem, which is what I wanted to point out in this specific slide. So it has basically a number of stakeholders, a number of use cases interactions, and the number of metrics that are relevant to each of this use case is also humongous. And the data points that that are underlying to calculate those metrics are also a lot of things that needs to be taken care. So the type of data items, it could vary from the physical exposures, which we'll be seeing in the subsequent part of the presentations, and what are the inherent challenges to each of those data pointers. So this is the specific finding from one of the NGFS report, which clearly points out that when it comes to the climate risk data management, what are the key challenges? So there are 9 different challenge category that has been pointed out, and predominantly most of the challenges what we are seeing is ultimately boils down to one of these core challenge category. When it comes to auditability, the auditability of climate data has been recently subject to a lot of criticism. In fact, US Security Exchange Commission recently has come up with the climate focused regulation, which basically focuses on one of the key requirements is also focus on auditability of the climate data. How do they basically validate and assure their climate data, which the banks and financial institutions are using in their climate models. So the auditability has been gaining a lot of momentum. And the granularity is another important aspect, where when it comes to the physical risk and the transition risk aspects data, getting the climate data at multiple levels, for example, at a counterparty or an entity level, and at each of the granular assets level, it lacks a specific location information, because that's one of the core challenge. Typically, the banks and financial institutions have have not encountered gathering this climate specific data at multiple granular level. So that's the key pain point and key challenge. And often the climate data relies upon various estimation and modeling, because some of the metrics are forward looking nature, which in turn requires the banks to have the technical expertise to do the necessary analysis, so that their climate ecosystem can be improved to achieve the necessary level of accuracy for the climate data. and and finally it basically boils down to some of the cost that are inherent in building out the necessary granular data and building out the necessary data ecosystem, because ultimately it has a follow-on impact on their investment decisions, their various lending decisions, and also their overall risk exposure quantification, which is core importance for various stakeholder community, because they wanted to understand how each of the institution has an exposure on both physical and transition risk, and how they are planning their overall net zero transition. How are they basically moving from carbon intensive sectors to less carbon intensive sectors? How are they making their portfolio greener? Because now there is a lot of stakeholder interest within the banks and financial institutions. Before institutional investors invest on a specific asset, they wanted to understand those aspects, for which this key challenges related to the climate data has to be properly addressed. So moving on, here basically we are breaking through the climate risk data ecosystem and the complexity that is inherent in the climate risk management. So typically the quantification of climate related financial risk to the banks, that involves basically translating the various corporate exposures, the bank's exposures, and what is their mitigants to avoid the to calculate the various metrics of financial risk. So if you look at it here, it involves three different layers of it. Starting with the climate science layer, we have the financial impact layer, then comes the actual climate risk layer. So as part of the climate science layer, it is more to understand various physical risk and transitional risk factors that are important, and firms have to basically perform what is to their business model, what are the physical risk factors and transition risk factors that are relevant to their impact, and what are the risk and opportunities due to those factors. The second layer is essentially translating the specific climate related risk impact into their economic impact, which basically demands how is their profit and loss, how is their revenues getting impacted, how is the demand and supply is getting shifted as they move towards low carbon products, and what is the impact on their overall sales output and subsequently the P&L. And these measures, if you look at it, has to be properly translated to the underlying risk management metrics. Ultimately, that results in what is the impact to their ability to pay, that is the probability of default, what is the impact to their recovery, and then the loss given default, and some of their collateral values, and what is the increased loss provisions. As more and more industries are moving toward net zero transitions, a lot of the assets will go standard. That means that will not be no more useful for their business purpose, especially the oil and gas and energy industries. So that will result in a lot of defaults and increased loss provisions for the banks as well. So this complex ecosystem of translating the climate science into the financial impact and converting that into the climate risk, basically there are many reasons to it, because the important one is that compared to the traditional risk categories like credit risk, market risk, and operational risk, the climate risk is significantly different. Mainly, this is more of a green swan in nature. That's basically the impact of climate change is highly uncertain, but there is a high chance that some combination of physical as well as transition risk is going to happen, and the banks have to be prepared to address those challenges. And secondly, it is also the climate catastrophes are more serious than some of the matured or more serious financial crimes that we have recently seen within the markets. And there is also the cascade effect when it comes to climate risk. One sector that is getting impacted due to the various physical and transition risk, it also cascades through multiple chain reactions. So the cascade effects and the complex chain reaction are taking into account the various supply chain effects is also inherent. And these basically hinges upon the multiple layers of uncertainty that is arising due to the climate when you actually model the physical as well as transition risk models. And there is also a lot of human judgment in terms of calculating the impact of these climate risk on their business model. So Moving on, we wanted to basically expand and double click on this complexity layer. So we spoke about the three different layers of the climate risk management. Here, basically, we are expanding the the data requirements across each of these layers. So within the climate science, we wanted to understand the various physical as well as transition risk events and what is the event intensity and their occurrences. So you need to gather the granular data at each of your asset level and also your locations level. So here the resolution matters. So the granular data that you get, the more accurate your metrics and your reported effects will be there. The second layer will be more of a, you need to understand from the financial institutions perspectives, where are the assets are located and where are the counterparties operations are largely important, because when it comes to physical risk, you need to gather their location data. Location data is very critical. And when it comes to transition risk, understanding the energy mix and how is their emissions composition when it comes to the emissions, the scope 1, scope 2, and scope 3, how is that basically being relevant in the current landscape, and how are they plan to reduce those emissions. And when they incorporate low carbon products, how the market is going to respond, whether the customer demand and supply pattern is going to positively impact their books or it is going to negatively impact them. So that level of financial impact is varying for each of the sectors. So the sector specific SMEs have to share their knowledge apart from the climate change experts, because if you look at the holistically this climate risk complexity, the ecosystem, it involves a number of parties from the banks. You need a climate science expert and also the sector specific expert, and you need to know, you need to have a knowledge from the climate risk SME and also the various sector credit specific SMEs. You need to have their knowledge. Finally, that has to be translated to the risk metrics like PD, LGD, the various accountability metrics, including climate war and what is the carbon adequacy ratio. And those metrics are comes at the last stage of your overall climate risk ecosystem. So this basically covers the type of data that you require, the type of granular data that you require across the climate risk value chain, and all the challenges that we are going to discuss in the subsequent slide revolves around this core fundamental data requirements. This basically specifically focus on when it comes to climate risk management, multiple banks and financial institutions, they depends on multiple climate specific scenarios, and they use those scenarios and subject their books and to understand what is the impact of each of their forward looking scenarios. So there are four scenarios that has been largely recommended and used in across Europe and UK and Europe, and we also largely seeing that these kind of climate specific scenarios will be largely leveraged across other jurisdictions as well. If you look at it, the orderly scenarios, disorderly scenarios, and hothouse world scenarios, and too little, too late. These four scenarios, across these four scenarios, the data that you require, the banks and financial institutions typically look for these kind of data segments in order to carry out the scenario analysis. For example, when there is an orderly scenario, you need to have the companies and sectors emission level, because that's a primarily because you are planning your transition well ahead in the life cycle, and you can basically measure how you are going to cut your emissions starting from today for the next 10 years. And when it comes to disorderly scenarios, it is going to basically introduce sudden policy measures and sudden policy changes. So you need to know how your cost of emissions and your quantity of emissions is going to change, and how you are going to change your energy mix and your emission categories accordingly, and how each of the government policies across various jurisdictions is going to play across this specific disorderly scenarios, and what are the sectors level impact across each of this disorderly scenarios categories. And when it comes to the hot house world, there is no specific immediate action, but it is going to be the action at a very later period. So you need to know how your physical risk characteristics is going to change, how many catastrophic event are going to be happening in the future measures, and how your measures, the mitigation and adaptation measures that you are taking, that varies from each of the sector, how they are going to respond to these hothouse world scenarios. So this basically gives you an idea about how each of the scenarios require you to build your climate risk data ecosystem, what kind of data that you require. In the fourth scenario, you might need to require larger data segments, combining this hothouse world and disorderly scenarios. So essentially, you need to combine the sudden policy response as well as the the increased physical risk scenarios, you may need a higher set of data requirements for this fourth scenario. So we discussed a lot of things around what kind of data that you might require, what are the, you basically unbundled the complexity in the climate risk data ecosystem. Here, the part 2, we are going to discuss about the current state limitations and gaps. So when it comes to the climate risk data ecosystems, these are the current state limitations and gaps that we are observing across the market. Since 2019, larger number of banks and institutions have basically started disclosing their climate specific exposures, and the climate disclosures have been disclosed as part of their annual reporting, as well as following the TCFD guidance. Though majority of the firms, they follow the TCFD guidelines and publish their climate reports, still there is a lot of improvement that is required, because in terms of ensuring the global consistency across their reporting standards. Recently, ISSB has published integrated reporting guidelines, through which they are trying to consolidate various reporting frameworks like GRI, SASB, and so on. And hopefully that will basically address these issues. That is going to be one of the key issues, because you need to have the consistent reporting across your various sectors and jurisdictions for you to easily aggregate your reporting metrics, consume that data. Second aspect is when it comes to physical risk exposures, the data for various entities is also shaping up, and the granularity of a physical risk is a challenge here. And most of the firms, it results in the proxy measures, because if they are not able to find the granular data at a building level or a specific county level, they wanted to approximate at a higher granular, higher geography level, which always results in the compromising your overall risk accuracy, as well as the metrics that you're going to put forth will not be so accurate. And the third aspect is, most importantly, the data point about the cascading impact of physical and the transition risk. That means, for example, if you include the supply chain impact, the institutions, most of the banks and financial institutions, they might have a very good amount of data about their counterparties and their borrowers, but there is a lack of supply chain data of firms, how each of the climate risk impact is having an impact on the counterparties, and subsequently how it is cascading throughout your supply chain. So that is something like a significant gap in the today's landscape. And when it comes to the climate risk estimation, it's all about the forward-looking view that we spoke about. So when specific type of physical and transitional risk arises, what would be the potential financial impact to the firm's business? For example, if you talk about the climate-specific VAR metrics, each of the industries is subjected to a different intensity of the impact, and the financial impact subjected to their business model is also significantly varying. So it takes time to build the forward-looking view, because it requires both understanding of the climate impacts as well as your sector-specific impact, how each of the industries is going to behave, whether they have a good ability in terms of pass through their increased cost to their customers. So that level of impact is very relevant here. So it largely revolves around consistency, availability, and granularity. Some of these challenges are more prevalent in the emerging markets as well, because when it comes to collecting the necessary granular climate-specific data and aggregating them, it involves absolutely a lot of funding, and some of these challenges, what we have seen here, is also more relevant in the emerging markets, because you have a lot of physical risk and transition risk data that is largely absent, and institutions are trying to improve their climate risk data ecosystems, trying to find out the data providers who can provide the necessary data points to address these core challenges. Moving on, we wanted to cover some of the key challenges for each of the use case. So we have looked at holistically, we looked at the current state limitations and gaps. Here we wanted to expand on some of the core challenges that are relevant to the physical risk landscape. So when it comes to physical risk, the first one is more of a prevalence of extreme weather events, and how the gradual changes in the climate that is happening across various locations. So here the challenge is that the physical risk, they differ in terms of their scope. So in terms of the depth and breadth of the locations that you're going to have, and the spatial granularity that you're going to get your data, globally, that is one of the challenge. Though we are having a lot of data providers provide this specific granular data of the physical risk. This data gap is still being addressed, and there is a lot of improvement that is happening. There are emerging data providers who is trying to address these specific granularity issues through a number of technologies, including satellites and so on. And basically, it prevents the institution to compare various physical risk exposures across entities. Unless you have the granular data, unless you have a consistent data across various jurisdictions, the comparison is the key challenge. So, and one of the data provider is the NDGuide. So they basically provide the country level, and they are trying to expand their spatial granularity of the physical risk exposures as well. When it comes to location, matching the data between the location entities of various geographical points with that on the drivers of a physical risk. For example, you might have a different notation that is being provided by the data provider, but when it comes to the banks consuming the data and matching up the data providers, there is a lack of a common data key that impacts the easy aggregation, because you will have to have the same key with your data provider and what you have as a reference data. There is a challenge that is being inherent in matching the data points. And if you take an example of, it is basically if you take an example of a mortgage, you will have the data that is coming in the geolocation, but you will have in your repository as a postal code. So you will have to basically convert these postal code into the geolocation gate, or vice versa. Then it will resolve this specific common key for your matching your location data. The third aspect is around supply chain. So the lack of supply chain, which critical to quantify your broader exposures to the physical risk, including how it is basically cascading across various sectors. Because the physical hazard happens to a specific sector will ultimately result in a cascading effect to other sectors as well. So this specific supply chain data is critical to fully assess your physical risk exposures. The next one is around how the crystallization or materialization of your physical risk across sectors, because the lack of data around how each of the physical exposures, for example, when earthquake happens on a specific location, the intensity with which it impacts the specific sector is actually varying. For example, when there is a flood in a specific location, the impact it has on a logistics or a transportation sector will be significantly high compared to an information technology or a telecommunication sector. So that's the specific sector-specific impact that you need to understand, with which you can precisely quantify the physical risk exposures, and you can subsequently quantify what is the impairment to the counterparties that you have granted your loans to the specific sectors. The next aspect is around the data points around various adaptation measures that are being taken by the counterparties and borrowers companies. You need to basically assume that you need to consume the data point to precisely quantify your physical risk exposures, because the absence of the adaptation measures will give you a measure which is actually overestimate, because the company would have taken enough climate risk adaptation measures. So you will have to understand the various measures and the various initiatives that they have put forth and consume that, plug that into your models. Only then you will have the accurate measures. The last core driver data point that is very relevant is your overall mitigations and insurance. Apart from your adaptation, you also have to take into the various mitigation measures that is taken by the company. For example, if the company has taken the enough of insurance, you will have to consume that data and incorporate that into your quantification models. Otherwise, it will be overestimation or underestimation of the relevant physical risk. Moving on, the similar view on the transition risk aspect. When it comes to the transition risk, the greenhouse gas emissions data. This is one of the core and foremost important challenge many of the institutions are focusing. There is a lack of standardization of metrics, and of course there is a standardized disclosures. There is a complexity in terms of getting the data from the report from the counterparties, and consume the data. Aggregation is a challenge. And ultimately, there is also absence of the scope 1, scope 2, scope 3 emissions from majority of the institutions. When it comes to non-financial entities, still the scope of disclosures around these emissions is still improving. So, and next attribute is around carbon pricing. So when it comes to carbon pricing, how each of the institutions is prepared to pass through the increased cost. Let us say an example of if the $100 is the carbon pricing for per ton of carbon dioxide today, and we are foreseeing that next year it is going to be increased to 150. So this all ultimately results in their overall carbon pricing or carbon cost that they will have to incur. And how are they going to, each of the companies going to pass through their cost to the end consumers? If they are better capable, better positioned to pass through that cost, then there is a lesser impact to their overall ability to pay, because it will not significantly impact to their overall P&L. So that level of carbon pricing data, ability to pass through their carbon pricing cost to the consumers, is a significant aspect, which is mostly a firm specific one. Because each of the, if you consider two firms in FMCG sector, each of the firm will be significantly, each of the firm will be differently prepared to pass through their increased cost to their end consumers. So based on that, their impact on their carbon pricing will also vary. So it's both a sector specific as well as firm specific data that you may need. Supply chain data is something that we already discussed, that's relevant to both from physical as well as transition risk perspectives, because it has a cascading in nature. And the next data point is around transition plan. When it comes to the net zero transition, how each of the firm is being prepared. You need to understand their transition plan, so that their future initiatives that they have already planned to cut their emissions, to reduce their overall carbon footprint, will have a significant impact. So you need to understand their future transition plan and include in your specific transition risk plan. The specifically the scope 3 emissions. Though majority of the non-financial entities like oil and gas and energy firms, they have started disclosing their emissions. Scope 3 emission is still a challenge here, and many of the firms are yet to accurately follow various protocols and compute their scope 3 emissions and report them. That is still evolving practice, and globally, very minimal number of firms, non-financial entities, report their scope 3 emissions, which is the challenge for banks, because that's the significant. If you look at the oil and gas firm, their 80 to 70, 75 to 80% of their emissions lies in the scope 3 bucket. So they will have to properly compute the scope 3 emissions and report to it. The next core data point is around their supply demand pattern variation due to the transition risk. So when the transition happens, how each of the firms supply chain variation is actually happening. And you need to understand, for example, if you take an energy efficient building sales, if you take an example of a commercial real estate, where there is a energy efficient buildings have been built and that has been rolled out, there will always be increased supply demand to the energy efficient buildings, which ultimately hits the real estate party who is actually engaged in the business of not so energy efficient building. So it will have an impact on your supply demand pattern variations. So this is one of the examples that I am providing for a commercial real estate. So similarly, for each of the entities, each of the sector, this supply demand pattern is a critical aspect that you need to understand and plug into your models. The next couple of aspects around the investments, various technology investments that you are making for you to move to the low carbon product manufacturing, how you are making the similar investments in the current state, how it is going to grow in the future. So the various investments that you are making, for the counterpart is making, banks have to understand the various investments data from the firms and have to appropriately plug in them. The last point is around the productivity impact. When there is a physical risk event happens in a specific locations, how each of the counterparties productivity is going to impact, and what percentage of their current productivity is going to increase, is getting impacted, because of which there is going to be annual profitability variations. So such a level of data points is critical. So this largely covers the data points and the core requirements. We wanted to double click or expand on the scenario analysis. When it comes to the scenario analysis, you could see that the physical variables and the transition variables, and also the number of macro financial variables that financial institutions are currently considering. And when it comes to the data that you supply for your scenario models, you will have to custom made your scenarios. You have to basically adjust your scenarios to each of the jurisdictions. You need to understand the various policies and adaptation measures that are relevant to the specific jurisdictions, and you will have to tweak your climate specific scenarios, and then basically supply that as an input to your stress testing. And that's one of the challenge. You will have to basically tweak your scenarios according to each of the jurisdictions. The second challenge is typically the institutions stress testing on your capital stress testing, regulatory capital stress testing, and economic capital stress testing. You will consider in the broader range of 3 to 5 years as a maximum duration, but when it comes to the climate risk, the time duration is the time horizon is the challenge aspect. You will typically encounter scenarios for 20 years, 30 years. That's the typical case with the credit risk, climate risk management, and it comes at the cost of more demanding data requirements. And when you extrapolate, when you think about the climate data for the next 30 years, this will also have a lot of uncertainty, and you will have to overcome those uncertainties with a lot of assumptions and your sector specific analysis as well. And there is also a lot of challenge in terms of the practical observations, the empirical data that you see for each of the assumptions that you're making. For example, the ability to pass through your increased cost is something that we have discussed. When the transition happens, when the carbon pricing is significantly increased, how each of your sector entities, how each of your borrowers are going to respond, how they are going to pass the additional cost to the consumers is largely varying, and you need to have a dialogue with the counterparties. You need to spend a lot of effort in terms of understanding those specific data points and include in your specific models. So these are the various data specific challenges and data requirements that we can understand from physical risk models, transition risk models, climate specific scenario analysis, and stress testing. The next section we wanted to cover about how is the industry responding, because it's a newer risk taxonomy and is also cross-cutting in nature. So that means unlike your credit operational and market liquidity risk, it has a cross-cutting in nature, and that's what industry calls like a transverse risk. So the increased climate risk will have a subsequent impact on your credit market and operational risk that you are going to report. So it is also evolving, and a lot of banks and financial institutions are specifically created working groups to address this climate risk data ecosystems. So we will quickly touch upon each of these pointers, how the industry is being addressing this various data challenges. So when it comes to the granularity issues for your asset footprint data, one of the proposition, there are three ways industry is approaching. One is that you better prepare to engage with your counterparties and borrowers, because that's a time consuming, but that's the first proposed way to accurately capture your counterparties data. You can engage with them through questionnaires and your various data collection initiatives. Secondly, you can rely on various third parties. They are improving their granularity data requirements. The third aspect is that when you collect such asset footprint data from your counterparties, you will also have to take care of a lot of privacy considerations like GDPR, and CCPA has a lot of impacts on your privacy concerns as well. So while you engage with the counterparties and rely on third parties, you will also have to parallelly take care of your privacy considerations to make sure that you are not breaching the privacy aspects of it. When it comes to the coverage of a physical hazards data, there is a lack of coverage with respect to various physical risk hazards. For example, when it comes to Australia geography, let me give you an example. The bushfire and the heat waves is actually a significant threat. But if a data provider does not provide you that, you will have to take a significant care to understand which data providers provides you the data about various physical hazards that is pertinent to that specific locations. Because unless you have the physical hazards, detailed granular physical data relevant to that jurisdiction, your risk estimation will always be underestimation. And the third aspect is around emissions. So when it comes to the emissions data availability for entities which are not disclosing their corporate emissions, it is currently it is largely related to the public entities. Close to 16,000 companies, publicly listed companies, are disclosing their emissions, but still there is a lot of improvement that is required. So you will have to basically converge with them, you will have to engage with them, motivate them to calculate the relevant emissions. And especially with respect to scope 3 emissions, currently most of the banks and financial institutions are developing the proxy approach. So when it comes to emission calculations, partnership for carbon accounting financials and greenhouse gas accounting protocol is the standard. So industry is following their guidelines and developing the proxy approach for the scope 3 emissions, because 80% of the entities do not display the scope 3 emissions, but you will have to ultimately approximate them with the proxy measures. But it still has to be improved. It is not accurate one, but currently how the industry is approaching, they are developing various proxy measures. There is a third-party verification of your emissions data, the various climate data that you are consuming. The lot of assurance is actually evolving. And when it comes to the input data coverage with respect to asset classes, sectors, and geographic areas. A lot of third-party providers are improving their data granularity and the data coverage that's being improved. And when it comes to transition risk data, you need to gather a lot of information that we have already seen. You need to gather their energy mix, their emission pathways, how are they going to increase their various policies data, their various investments data. So you need to understand them various sources. So majority of the data providers are leveraging emerging technologies, including machine learning and AI technologies, to gather those data points and provide the amalgamated, aggregated data to the consumption of banks and financial institutions. A lot of data providers are leveraging various emerging technologies to gather those data, to prepare the data from various sources and aggregate those data and make it available for the financial sector community. The last one is around the converting the data into the financial impact. A lot of open source communities and NGO communities are enhancing the resolution of the coverage of physical hazard data and also providing the financial impact of each of the physical hazards. For example, Climate Invest, E3CS. So open source climate communities are embarked on the global initiatives and provide the direction for the financial sector entities to advise them how each of the climate data can be prepared, how the practices can be evolutionized, so that it basically provides the common platform for banks and financial institutions to leverage and to get to know about the best practices about building this climate risk data ecosystem. And briefly touch upon this recommendations from NGFS in terms of addressing these various data issues and the data gaps that is prevalent in the today's situation, how it can be basically addressed. So NGFS has provided 4 different metrics around developing the decision useful metrics. So when it comes to the developing the necessary climate risk metrics, you will have to basically take care of, you will have to leverage the common research and developments that has already happened through science-based target initiatives, where they basically done a number of research and come up with the critical findings on how you will have to basically understand the transition nature of various firms, how you can basically develop various metrics. IEA, the International Renewable Energy, and the IPCC, WRI, they all came up with the specific metrics and scenarios. They provide various guidelines and metrics. So institutions have to basically follow these decision useful metrics and leveraging the available data research. There is a number of research that has been already done through various NGOs and various common international bodies, like NGFS and ISSP. So you will have to basically leverage various technologies like machine learning and AI, and using the open source platforms. And there is a BIS, recently BIS has also built the innovation hub to specifically address the climate risk data and the data inherent problems. So you can basically leverage those innovation hub and the shared platforms. The common disclosure standards is something that we have already spoken about. The reporting requirements and the consistent format is slowly evolving, and the industry is still trying to find the common reporting standards for the climate risk. The fourth aspect is around the reporting taxonomies. In the individual jurisdictions follow different taxonomies when it comes to the climate specific reporting. So for example, ISIC, NACE, NAICS, these are the classifications that are being widely adopted in Europe, US, and UK. So ultimately, it has to be converged, and globally there has to be a unique shared reporting taxonomy has to be developed. That practice is something like evolving. And these are some of the core recommendations that has been provided in the very recent report that has been published by NGFS, specifically focusing on addressing the global data gaps in the climate risk environment. And all of these factors are very relevant because the industry is rightly moving in this direction to address the emerging problems. Last part, we would like to share some of the, I'm closely monitoring, closely keeping track of various reports that are being published by major banks and financial institutions, their annual disclosures, their TCFD reports. I've extracted some of the 4 different climate specific case studies, which is very recently published by major banks. This is one of the, and I would like to share 4 case studies specifically focusing on there are a number of informations that are available with respect to each of these exercises, but I specifically focused upon the data problem. For this is one of the large US banks. They wanted to basically align their portfolio with respect to various climate performance, and they wanted to build the climate specific ecosystem That platform will provide various climate specific metrics, starting with the emission based analysis and how their financed emissions is shaping up. So when it comes to this use case, that's the use case the bank has basically embarked upon. And the data challenge that is relevant to here is that the most of their counterparties, they don't report the scope 1 and scope 2 emissions, because that's an inherent challenge in terms of accurately carrying out your emission reduction targets. Unless you understand what is the current footprint of your emissions, you will not be in a position to accurately come up with your transition plans, so that it is largely to address the incomplete emissions data supplied as your input for your transition risk analysis. And what the company has done is that how they have basically addressed these issues, they basically relied upon one of the platform called TrueCost. Of course, it's a known, very known platform. So that's the provider that they have currently leveraging for the emissions data. But when it comes to the counterparties who do not report the scope 1 and scope 2 emissions, they followed the alternative proxy methods, where they started looking into the company revenue data, and where the carbon metrics specific to their counterparties will be derived based on the revenues data. Um, uh, they consider the specific sector where they belong to, and for that sector, what is the average level of carbon metrics, the ton of carbon dioxide relevant to each of the $1 million of USD revenue. And based on that, they basically project and compute the various emissions information based on the revenue informations. And even in the worst case, where even if you don't have the specific revenue data for your counterparties, you don't have emissions data, you don't have revenue data, then how can they basically compute that? Then they basically go ahead with the industry average or sub-industry average for the carbon footprint, and they are currently using that to compute the overall emissions. And based on that, they basically created the current footprint, and they created the transition plans. But it is an alternative or a proxy approach that they currently are having, and how they are basically currently managing. Of course, they will have to follow one of the approaches and try to gather all the emissions data that is relevant to them to build the credible transition plans. But this is the way how they are currently approaching. This is a first case study. The second case study is around one of the major leading Italian bank, where they wanted to analyze the impact of physical climate change risk on their top exposure portfolio relevant to their oil and gas sectors. And the objective is to estimate what is the financial impact of their physical climate risk on this oil and gas sector, and translating those climate risk data into the credit risk metrics, the probability of default. So the core challenge, that's a use case relevant to this case study. But the core data challenge, what they have is that the lack of detailed information of the geographical location data of all of your counterparties operations. And due to that, because there are a large number of counterparties, and each of the counterparties borrower has a number of assets where they are operating from. So the granularity of the site data and the locations data is actually a critical gap here. But how they have basically addressed, they, in order to source the plant geographical locations where it's not readily available, the the methodology that they've adopted is going to the Bloomberg and the Capital IQ sites, where the Bloomberg Maps geospecific methodology basically provides the data points around the location of each of their for each of their borrowers, where are their assets are located, where are their plants are operating from. And then basically that can be considered as a critical input for your physical climate risk models. Then once you know the location data, each of the perils that are being subjected, and what is the financial impact, what is the subsequent PD impact can be arrived. But this is the core data gap that has been addressed by the bank. The third case study is around one of the leading UK bank, where they, as part of their financed emissions calculations, they wanted to understand the emissions that are relevant to each of their counterparties. And that is one of the core gap here. The core use case here is that they wanted to understand what is the financed emissions as of today, and for which the scope 1 and scope 2 and scope 3 emission is a critical. And but that's the coverage is the issue, and they have a lot of data for a lot of their counterparties. The emissions data has been like a big gap. The second gap is around, for as part of their overall physical risk and transition risk analysis, the energy performance certificate of their real estate exposures has been the gap. So they don't have, for majority of their properties that they are lending to, they don't have the energy performance certificate, because that is one of the key aspect to understand how each of your real estate exposures is performing when it comes to the carbon reduction. So these two data gaps were prevalent in the this specific example, and what they have followed is that the Partnership for Carbon Accounting Financials, PCAF basically provides you the alternative approach or the proxy approach. They basically provide you the data quality scorecard. So when it comes to the emissions data, they have built the 5 levels scorecard. So when it comes to the emissions data, starting from score 1 to score 5 is the layer that they have provided. So where there is a significant absence of your estimation of your emissions data, that is the scope 5. That means you will have to basically estimate using the proxy approach and use that data for your climate specific models, be it physical climate or transitional climate or scenario analysis. That's a scope 5. And institutions have to put in a lot of measures to improve, because score 1 is the higher most certain data or accuracy, and the score 5 is the lower most uncertainty data. So you will have to slowly improve your data quality score using the proxy data based on region, or you apply the average data at the specific subsector level. Then you have to basically connect with the counterparties, gather the relevant data. You have to third party do the third party validation of your emissions data, so that you can achieve the score 1. So the bank was trying to adopt this PCAF general data quality scorecard for emissions, and they were currently at the range of score 5, where they were, for some of the counterparties, their emissions data was estimated, because there is no data currently, so they will have to estimate it using the proxy approach, which they have adapted through the proxy data on the basis of regions and country, and also based on the subsector and specific, so that they can move on to the score 3. And as a next step, they will have to improve to how they can move on to the score 2 and the score 1. So that is how they can propagate from one very low quality data to the high quality data through various steps that has been suggested by PCAF. So currently they have adapted the second step and the third step, average the emissions data based on industry and subsector. So that's the how they have addressed the first issue. The second issue is around energy performance certificates. So when it comes to the properties, that of their properties do not have the EPC data. So what they have done is that they looked into the specific sectors and the specific regions, how each of the emission intensity or where they are currently lacking into, and map those data points to the your real estate sectors, and use that EPC banding as a consideration. Though it is an inaccurate and proxy measures, unless they take, because it's a time consuming exercise, you will have to reach out to each of the borrowers or real estate exposures counterparties and understand the accurate energy band for each of the exposures where you are lended to. And because it's a time consuming exercise, currently there is a need to disclose your emissions, and this is how currently the bank is actually approaching. The last case study is around one of the UK bank. So here the similar for the retail mortgage portfolio, the use case is for the retail mortgage portfolio, they wanted to model the probability of default impact of their climate risk. So they basically wanted to include the climate risk flavor into their PD portfolio and recalibrate their PD models for the climate risk impact. For this, because it's a retail mortgage portfolio, unlike we discussed in the previous case study, the energy performance certificate of the property is the key determinant of the risk, because the least efficient properties, which are in the range of band D and G, they are most exposed to rising energy prices. So when there is a energy price significant increase, these properties are significantly subjected to the heavy energy cost, and they have the highest retrofitting cost as well. But banks did not have the energy performance band for most of their residential property portfolio. But how they have raised it, they have done a couple of ways. They have, for retail portfolio, how they have assumed is that the properties that were built prior to the 2000, they have assigned a significant EPC band of C, and properties built during the prior to the year 2000, they provided based on the EPC ratings and their exposure, their current percentage of weightage within the portfolio. For example, if 20% of the properties they have EPC rent of G, then the probability of assigning the EPC rating of G to that portfolio is 20%. Based on this bucket level variations, they have assigned the EPC ratings and consumed that data for your physical climate risk analysis. This is for a retail portfolio. And when it comes to the commercial real estate or the commercial property portfolio, instead of proxying the energy performance certificate for a band for properties, they basically assumed the impairment rate based on the comparable buildings. They do not have the EPC data that is currently available. Based on the industry average, based on the portfolio average, they assigned this specific band for the commercial real estate. So this is how basically the industry is approaching the practical examples of how the industry is approaching each of the specific use cases that we discussed about. We discussed about scenario analysis, physical climate risk modeling, transition climate risk modeling, and also the finance the emissions and their transition plan portfolio. So these 4 use cases we touched upon. Likewise, there are a number of case studies where industry is encountering these real data problems, and they are adapting to various proxy measures and alternative methodologies to address these problems. Though there is a lot of room for improvements and a lot of because the industry is evolving, it's a newer risk type, newer risk category. Various data providers are also making their energy to improve their data to address the granularity, availability, their auditability, and accuracy, complexity, comprehensiveness issues. Industry is progressing, and the banks and financial institutions, if you look at the very recent TCFD reports for any major bank, they have dedicatedly talk about climate risk data at least in 100 plus places, because that's the core problem to be addressed for them to build the subsequent capabilities. In order for bank to accurately come up with the climate risk stress testing or a better understanding of their exposures, you need to build your data ecosystem, you need to build your data capabilities, and you need to gather all the right data and make sure that the data that you're gathering is fit for purpose and accurate. So that's the industry direction that I wanted to share with you. With that, I think so there are some of the industry references. I think considering the time, I would like to move on to the Q&A. Any specific queries that you wanted to clarify, and I'm happy to address. If there is something that I'm not able to address, we'll be happy to clarify offline as well.
Thank you, sir. This is Kumar. It's a very insightful session. I just have a question.
Sir, your voice is not clear.
Okay, is it better now? Is it better now?
Yes, Kumar.
Okay. Sir, I was going through your presentation. I think at a couple of places you mentioned that the climate risk need to be integrated into the existing risk management framework, that is credit ops and market risk. But if you look at the nature of this risks, whether it is credit ops or market risk, they are either mostly an individual silo-based approach or a more of a portfolio-based approach. But given the nature of climate risk, which is more of concurrent or a catastrophe, because it happens all of a sudden, and it's not more, it's beyond the cascading effect. It is more of a concurrent and a catastrophe. So what models do you think are required to bring into the model to make climate risk converge into the existing risk models?
Exactly. Thanks, Kumar, for asking this question. As I think you are right. So embedding the climate risk into the traditional risk management, be it you basically pointed about the credit risk models, and there is also a significant challenge, similar challenge in integrating the climate risk factor into the existing risk models, be it market, operational, or liquidity. So let us, for the sake of discussion, yes, let us take an example of a climate credit risk. How you were across your credit risk value chain, right from credit origination till the point of credit reporting, there are a number of risk metrics that are typically have been there for since the evolution of banking. But the challenge is in terms of understanding the financial impact of the climate risk. That's the significant aspects of it. If you look at that, once you understand the conceptual understanding of various climate risk factors that are relevant to your business model. For example, if you take an example of a transportation industry, each of the risk factors of physical and transition risk may not be relevant to them. So you will have to basically understand the risk factors relevant to them, relevant to this specific industry sector or your nature of business, and come up with the risk factors, climate specific risk factors that are relevant to your business, and translating because gaining the climate science aspect of it, if you look at that, the very first that we spoke about, 3 layers to it. Core challenge is in terms of converting the middle layer, you can easily gain the climate science layers with a lot of climate risk understanding that is going on for the past 2 years. This first pillar is something, very easily done. The last pillar is something like, industry has been very, very advanced in terms of impact to the key risk metrics is something, that has been there. You have a number of risk models that are currently there. And you also have a number of models that are well positioned to take care of various recalibrations. So because if you take an example of a pandemic, banks have to recalibrate their models quickly and come up with the newer measures. They will have to change their risk model so frequently. So banks and financial institutions are well positioned in the last layer as well. The middle part is the challenging one, where you will have to understand each of the risk factor. For example, how your specific climate risk scenario is impacting your portfolio, due to which there are a number of economic impacts of each of the scenarios is critical here. So that's when translating the climate risk factors into the financial impact is the core aspect which the financial institutions are struggling. So you will have to develop you will have to specifically design the physical risk and transition risk models. There are a number of advanced solution providers and modelers. They have come up with the models. There are a number of industry development models like integrated assessment model. You can basically browse through what is IAM. So I'll give you a hint. Integrated assessment model is nothing but this exactly addresses this issue. It looks into what are the key risk factors pertinent to physical and transition risk, how they can be converted to the various financial impacts. This is one such model IAM is providing. This has been used by widely majority of the banks and financial institutions. So they deal with converting the climate science layer into the financial impact layer. And then once you arrive at the actual P&L impact, your this middle portion, revenue impact, that is a necessary subject for your PD model that can be passed as a critical financial impact to your credit model as well as your market risk models and liquidity models as well. So arriving at this translating the impact model is something like majority of the banks are improving, and though there are a lot of research from central bodies like IAM, this is still an evolving practice, because you need to have a lot of aspects around economic impact and your social impact and your demand shift pattern. Unlike the traditional credit risk models, here you will have to bring in a lot of other aspects of as well. So that is still improving. Does that answer your question, Kumar?
Yeah, partly, but I also have a follow-up question if you don't mind.
Sure.
Especially on the recalibrating the PD models. Even the PD models also, we have a similar challenge. Either they are backward looking or either mostly a portfolio approach. So, but given a pandemic, something like pandemic, as you rightly mentioned, now the effect of this pandemic is, beyond a particular segment or beyond a particular company. It is like, it's so sudden that it doesn't even allow us to assess the damage it can do. So, what are the models which can bring into the PD model? Any work happening on this, or it still need to be evolved?
No, I think you're right. I think that is the specific point. I think integrated assessment model is one such space. There are number of integrated assessment models from various jurisdictions that is there, and Oxford University is also developing one such integrated assessment models. So this IAM models kind of thing basically looks into various physical and climate risk scenarios, various possibilities, and input that into the IAM model. The IAM model output will be like how each of these models is basically having an impact on your economic and your socio-economic pathway, which will be a necessary interest for all your risk models. Your PD models will basically require, okay, when there is a specific natural calamity, when there is a natural physical climate risk event, for example, if I take an example of earthquake, what is the significant impact of each of this? So each of the perils, each of the hazards, each of the climate risk aspects has a number of aspects, a number of assumptions to be taken into account before it is actually converted to the subsequent financial impact. You cannot, it is also, you are rightly mentioned, it is also so sector specific. That is why when in the industry is in the process of developing their sector specific models, you cannot follow the same IAM model for all your sector exposures. You will have to recalibrate, you will have to consider number of assumptions, sector specific assumptions also to be taken into account. One of the key points that we discussed about ability to pass through their increased cost. When there is a significant carbon pricing, how each of the sector is actually responding to that specific phenomena. So that is something sector specific. You will have to include a number of assumptions into your climate risk models to arrive at your various financial impact. Then that can be easily embedded into the PD models. It is still an evolving practice. The embedding the climate risk into the credit risk models, it is also largely an evolving practice now.
Yeah, this is Umashankar. Yeah, so actually with this impact on the financial layer, as this the PD, LGD, all these changes, will it also affect the IFRS 9 calculation, where we use the impairment of assets with these models, which we do that one. So how it will going to affect it? Because that is the next step. All the banks has to think about it. Just wanted to write a comment.
Exactly. Exactly, Umasagar. That's a very, very right point. Yes, it has a significant impact on their loss provisions as well. Because in the IFRS 9, you will have to basically, this will have impact on your stage 1 to stage 2 migration. So when you specifically focus on a specific asset, due to physical and before this embedding the climate risk into it, you will have a number of criteria. You will basically assume when a specific asset is moving from stage 1 to stage 2. But after you include physical and climate risk impact, the stage 1 to stage 2 demonstration is significantly going to increase. So it will have a significant impact on your CECL, the expected loss, expected credit loss, and also significant increase on your loss provisions as well. So because the flavor of embedding the climate risk into the credit risk is actually in the initial stages. A lot of models are, a lot of work is actually going in the industry. The ECL is also a significant bit, because once you have a matured understanding of all your embedded physical and transition risk, you will have a significant hit on your CECL as well. Banks have to well prepared. This will have a subsequently impact on their capital adequacy ratio as well, because it has an impact on your ECL. So there is a lot of lot of impact is there, which the financial institution is going to witness in the next 1 or 2 years, because it's a newer type. There is a lot of research and a lot of focus areas also going up. But that is you're right. There is a lot of impact on your CECL as well. You will have to recalibrate your loss provisions models, IFRS 9 models as well. There is going to be incorporation of the climate risk aspects into the capital adequacy ratios, regulatory capital, and your loss provisions. All those changes regulators are in the process of making.
Thank you.
Yeah, hi, this is Suresha here. I have a question.
Suresh.
Yeah, see, actually, I see today banks are struggling to meet Basel III reporting itself. In some countries, even Basel II itself, they're struggling. Under these circumstances, where we see getting the right data is a major challenge, what are the regulatory deadlines for incorporating climate risk as part of the reporting?
Sure, I think it is slowly evolving. When it comes to climate risk management, UK and Europe has been the front runner. In fact, UK has come up with the very, very initial guidelines around the climate risk management. And you must be aware that Bank of England has also conducted the climate risk stress testing, the biennial exploratory stress testing. It is clearly, it's unlike a traditional stress testing. It is called as a BES, biennial exploratory stress testing, and followed by ECB, and slowly now UK, Europe, US is also picking up. So in terms of guidelines, yes, UK is already in play. They have completed 2 rounds of stress testing across all the major UK banks and financial institutions. European Central Bank has recently conducted the stress test and published the results a couple of weeks back as well. So in terms of the initial regulatory stress testing, UK and Europe is well prepared, and there are timelines which has already surpassed, and institutions are still, in the process of improving. I think if you look at the very first slide, it is about the disclosures from the European Central Bank stress testing results as an outcome of stress test. What was the key assumptions? If you look into it, close to 80% of banks, they don't have the stress testing framework, because ultimately there is a capability implement on the data. You need the data, you need the framework, you need the expertise, you need to build the necessary capabilities. 80% of the banks are not prepared, and only 40% of the banks achieved the necessary climate stress testing requirements. So in terms of there is no hard and fast deadline, but in terms of mandatory conducting the climate stress testing has been there, and UK, Europe has already done 2 rounds of testing. US is yet to come up with the regulation with the mandatory timeline. Within APAC, we see that Hong Kong and Singapore has already come up with the climate disclosure requirement, but not on the climate stress testing regulation aspects of it. But if you look at the holistically, globally, climate risk disclosures has gained a lot of momentum. You need to have climate disclosures, but in order for banks to prepare, they'll have to further carry out the underlying necessary preliminary analysis. So disclosures part, there are a number of regulations. Stress testing, scenario analysis, UK and Europe has been leading. The other regulations are yet to pick up.
Great, thanks a lot.
Namaste, Mr. Gurusamy. My name is Siddharth here. The question that I have is specific to about, let's say, TCS here. So I understand TCS would have its own carbon neutrality objectives. So my question is, what is the experience of Indian entities in buying and selling carbon credits? And what are the steps that TCS specifically perhaps might be taking to reach its carbon neutrality objectives, if at all? Thank you so much.
Sure. So I'll address the first part of the question. Second part, something, I will have to gather additional insights and comment on it. But first part is, I think, when it comes to the Indian entities, Indian sectors, you must have seen that very recently, couple of days back, I think 3-4 days back. Sorry, last week, RBI has come up with very first climate specific regulatory document, which basically addresses upon, it's largely overlaps with what TCFD guidance is actually recommending. They come up with the clear guidelines around how the industry needs to, how the banks, various entities, all the public listed entities are. It's not about just a financial, even non-financial entities. RBI wants them to come up with the sustainability and the climate related disclosures. But when it comes to the carbon pricing, unlike Europe and UK, other jurisdictions, the emissions trading and the carbon trading is yet to evolve, because unless you have a lot of regulatory, because regulatory driven initiatives and the policy driven measures are the key point here. So that is something that needs to be evolved, because if you look at the overall carbon pricing and how it has evolutionized in the last 10 to 15 years, UK, Europe, you will have a lot of data. In India, it is yet to mature, and emissions trading and taking the carbon pricing relevant policies into the climate risk and sustainability umbrella is yet to be evolved, and there is a lot of white space to address.
Thank you, sir. Thank you so much.
Just a follow up on this question, sir. So when it comes to carbon pricing, so do you see a role which an insurance sector can play in this?
Exactly. It is one of the very important aspects to be considered, because when you take into account your transition risk aspect of it, you will have to consider how the each of the counterparties are actually insuring them against various physical and transition risk. Especially it is relevant from the physical risk point of view, because they might have, if you take an example of a flood, the real estate sector already would have purchased a required flooding insurance. So it is a more of a mitigation plan. So typically, insurance organizations have a lot of capability around climate risk management. They built a number of NatCat models to address the physical risk aspects of it. But when it comes to actual counterparties, borrowers from other entities, how it has an impact? Yes, it has an impact in terms of actually coming up with the accurate climate risk exposures, because you will have to take into account what is their investments, what is their insurance to address the various climate risk hazards. Only when you take into account your counterparty's preparedness for your various physical risk events, you will come up with the accurate physical risk impact. So it has an impact as well. This is the part that I specifically relevant to the insurance aspects of it. The example that I mentioned, it is something relevant to the flood defenses. If the company has already availed a specific insurance, they would have already mitigated through that insurance, flood insurance. So you will have to take those data points into account to actually come up with the physical risk, accurately come up with the physical risk for a counterparty.
Sir, in your knowledge, is there any application which is fully developed to enable banks to calculate their net zero obligations?
Sorry, could you brief about your question? Is it something like the capability to calculate the net zero effect?
Yes. Is there any IT application which has been fully developed, or also in the process?
No, it is also in the process. Largely, it is, if you look at the transition risk nature, unless it is also evolving space. So currently there is a lot of qualitative capabilities. So there is no IT applications as such, because there is a significant understanding to be done within the transition risk management. So if you look at that, SBTI, Science-Based Target Initiative, has been the common body. You can definitely look into that. They basically developed the qualitative scoring framework. They onboard a number of leading companies there as well. It is more of a qualitative framework they look into each of the companies, their organization, their governance, their risk management, their overall traditional transitional investments, and come up with the rating for how each of the company is managing. So it is more of a qualitative framework rather than the quantitative application.
Sir, could you please repeat that organization name?
It is Science-Based Targets Initiative, SBTI.
Okay, thank you.
Yeah. Thank you, Gurusamy. I think we are almost over by 17 minutes. If there are any further questions, please, I think, time to chat or directly to Gurusamy or to CRFC. I think we will coordinate with Gurusamy sir and get all the information because we have another session which is going to start at 9 o'clock. Sir, Hargovind sir, before that, before handing over to Hargovind sir, just I want to mention one thing. Thank you very much, Gurusamy, and thank you all the participants. And next week also at the same time, we have another interesting session. Let me share my screen and I show the flyer. I'm going to share this one. This is next week, Jayanti RV. She is going to conduct from a session on the climate risk reporting and regulatory labs. This is also, I believe this is the immediately after understanding the challenges, understanding what is the regulatory expertise is also very important and helpful for all of us. So request everyone to register and join for next week's session also. So over to Hargovind sir.
Climate Risk and Finance Council is really indebted to Kanan Rajamani and Shri S. Gurusamy, who took us through this amazing journey of disseminating very valuable information regarding the risks, especially the climate risks, and then the various models which he, enabled before us regarding physical risk and transit risk. Really, took us to dizzy heights, and we could really understand that the granular analysis of these risks at the time of appraising a loan is very, very important. Otherwise, we land up in problems. We've just seen the inundating of Sharjah market. Its entire commercial market was washed out because of the inclement weather and incessant rains which were not predicted and not factored in any of the credit decisions the lenders have taken there, and it resulted in losses. It is surprising from your deliberations to note that 60% of banks have still not embedded the climate risk components in their credit risk models, and they are just assessing the loan proposals, ignoring this very vital risk. It is also very, very disturbing to note that almost as much as 70 billion worth of dollars of losses have been incurred by various banks by ignoring the warning signs of climate risk. You took us to the entire journey like an expert, and there were a lot of learnings. And then the question answer session which you handled was also very impeccable. Thank you very much, sir, for sharing your valuable time. The council remains indebted to you for your valuable time. Thank you very much, and good night to everyone.